In this video, we're going to go over the homework problems that relate to Step 4 of the revenue recognition process, allocating the transaction price to each performance obligation. So in our Chapter 6 homework problem 1, we have Video Planet is selling a big screen TV package consisting of a 60-inch plasma TV, a universal remote, and on-site installation by VP staff. The installation includes programming the remote to have the TV interface with other parts of the customer's home entertainment system. VP concludes that the TV, remote, and installation service are separate performance obligations. So remember, as separate performance obligations, we have to allocate the revenue to each of the performance obligation. So VP sells the 60-inch TV separately for $1,280, sells the remote separately for $80, and offers the installation service separately for $240. The entire package sells for $1,500. So this type of cost allocation is very common in accounting. So if you buy a house and land together, the house gets depreciated, the land doesn't, so you have to allocate the purchase price between the house and the land. If you have 3 departments operating one floor or one building, you would need to allocate the rent and some of the other building costs to each one of the departments. If you purchase on the stock market, stock and rights attached or stocks and warrants attached, you have to allocate the purchase price to each one of the purchases. So let's get going. So we're going to look at the market value of each one. So MV is for market value. So the first one that we have is for the TV. Second one that we have is for the remote. And the third one is the installation service. So the market value of the TV separately is $1,280. The market value of the remote separately is $80. And the market value of the installation service separately is $240. So I'm going to total all of the market values. Just add the 3 together. And we get a total market value of $1,600 that's selling for $1,500. So now what I'm going to do is take each one and divide by the total. So I'm going to put in the formulas here. I'm not going to do the calculations. So I'm going to take 1,280 and divide by 1,600. I'm going to take 80 and divide by 1,600. And I'm going to take 240 and divide by 1,600. So now I'm going to do those calculations, and with Excel I can put in one formula. So here in cell D2, I'm going to tell Excel to take the market value of the TV and then divide by the total. Now as I copy that formula down to D3 and D4, it will change the B2 to B3 and B4, which is what I wanted to do, but it will also change the B5 to B6 and B7, which I don't want it to do. In fact, I'll get an error message. So before I hit enter, what I'm going to do is I'm going to hit the F4 key on your keyboard. On a laptop, you might have to hit Alt and then F4. But I'm going to hit F4 on my keyboard. You can also type the dollar signs. So I'm telling Excel to take the cell that's 2 to the left of the current one and always divide by B5. So I'm going to hit enter. Now all I have to do is use the fill handle on the bottom right hand corner. Notice my fat plus turns to a skinny plus. 4-headed arrow is different. Bottom right hand corner, skinny plus. Hold down the left mouse button and drag it down. So we have 8.8, which is 80%. 0.05, which is 5%, and 0.15, which is 15%. So now, to allocate the cost, what I'm going to do is I'm going to take the cost of the package, which is $1,500, The TV will be allocated 80% or 0.8 of the 1500. The remote will be allocated 5% or 0.05 of the 1500. And the installation service will be allocated 15% or 0.15. So let me put those formulas in. TV, remote, and install. So for the TV, we're going to take 0.8, and we're going to multiply that by the package price of 1500. Excuse me. If we multiply it by 1600, we would just get the 1280. So we have to make sure that we're allocating the package price, not the total price. Then, for the remote, I'm going to take 0.05, and I'm going to multiply it by the package price of 1500. And I'm going to take the installation service, 0.15, and multiply it by the package price of 1500. So now to calculate each of those, I just take 0.8 multiplied by 1500, 0.05 multiplied by 1500, and 0.15. Forgot my equal sign. 0.05 multiplied by 1500, and 0.15 multiplied by 1500. So we have 1200, 75, and 225. So over here in the Connect, I'm going to put in the answer 1200 for the TV, 75 for the remote, and 225 for the installation. And notice how the total revenue adds to the package price of $1,500. So that's how we do a cost allocation when we know the price of all of the components. Okay, we've got that right. Now let's move on to the next problem. So this next problem is also a cost allocation, but the problem with number 2 is we don't know the market value of all of the components. We only know the market value of some of the components. So in this case, what we do is we take the package price, we subtract out the individual price that we know, and that's going to equal the unknown individual price. So, for example, let's say I have a stock and the stock is going to trade with a warrant. Now, the warrant has never traded before, so I don't know how much the warrant costs. But I know the package price is $108, and if I was going to buy the stock without the warrant, it would be $100. So therefore, the amount that would be allocated to the unknown warrant would be the total package price, what I paid for the 2, minus the market value of the thing that I know. Then I would get to the market value of the thing that I don't know. So let's move on to number 2. I'm going to erase this right now because I don't want to confuse it with the problem. So in problem number 2, we have Clark's Inc., a shoe retailer, sells boots in different styles. In early November, the company starts selling sun boots to customers for $70 per pair. When a customer purchases a pair of sun boots, Clark's also gives the customer a 20% discount for any additional future purchases made in the next 30 days. Customers can't obtain the discount coupon otherwise. Clark's anticipates that approximately 10% of customers will utilize the coupon, and that on average, those customers will purchase additional goods that normally sell for $300. So I'm going to scroll down so you don't confuse my numbers from the other problem. So the first requirement is how many performance obligations are in a contract to buy a pair of sun boots. There are actually two performance obligations. The first performance obligation is to provide the pair of shoes. The second performance obligation is to allow the future discount. So they don't know whether the customer is going to take the future discount or not. So when we're unsure, we're going to calculate what is called a most likely amount. So for the first requirement, number 1, there are actually two performance obligations, as I said, one to deliver a pair of shoes and one to deliver a discount next period. Now, let's go on to requirement number 2. So under requirement number 2, assume Clark's cannot estimate the standalone selling price of a pair of sun boots without a coupon. Prepare a journal entry to record revenue for the sale of 1,200 pairs of sun boots. So let's move on with the problem. So the customer is going to be selling sun boots to $70 per pair, so that is going to be the package price. And we have 1,200 pairs of sun boots, so we're going to calculate the package revenue. So to calculate the package revenue, we're going to take the 1,200 pairs of shoes sold, multiplied by the $70 selling price for that package. Again, the package includes both the shoes and the coupon. So I'm going to take 1,200, multiply it by 70, and I get a total package price or package revenue that I would have from selling the 1,200 pairs of shoes, $84,000. Now I can estimate the value of the coupon, but I cannot get the value of a pair of shoes without the coupon. So let's calculate the value of the coupon. Now to calculate the value of the coupon, the first thing that we're going to calculate is the estimated number of customers that are going to use the coupon. So I'm just going to use parentheses where I'm not putting in the formula right now, I'm just showing the calculation. So to calculate the number of customers that are going to use the coupon, we sold 1,200 pair of shoes. So 1,200 customers are going to get the coupon, but notice it was estimated that approximately 10% of customers will utilize or use the coupon. So if I take 1,200 and multiply by 10%, that means that they're estimating that 120 customers are going to use the coupon. Now, each one of those 120 customers are going to purchase additional goods that normally sell for $300. So the total revenue from those 120 customers, 120 times 300. And then we were told that each of those customers, the coupon gives them a 20% discount. So each of those 120 customers will get, on the average, a $60 discount, which is 20% of $300. So 300 times 20%. So now I'm just going to put that formula into the computer. So I'm going to take 1,200, multiply it by 10%, so that calculates the number of customers. Then I'm going to multiply that by 300, which calculates the total revenue from the 1,200 customers. The 120 customers, 1,200 times 10%, and then I'm going to multiply that by the discount percentage of 20%. So once again, each of those 120 customers, 1,200 times 10%, will have on the average a $60 discount. So the total value of the coupon is estimated at $7,200. So now all we're going to do to subtract is to get the value of the shoes alone. So we take the 84,000 and we subtract the 7,200, and we have the value of the shoes alone, $76,800. Now, this is going to give us the journal entry right here. So, the total package revenue is what we're going to debit to either cash or accounts receivable. Now, what we're going to do is we're going to defer the $7,200 of revenue to the future when the people use the coupon, as opposed to this period when they just received the coupon. So this is going to be, the $7,200 is going to be a credit to deferred revenue. I'll zoom out a little bit so you can see what I'm typing. And let's get that old problem off of there. And now this is going to be the value of the shoes alone is the only thing that was sold this period. So this is going to be the credit to sales. So now let's put our journal entry in over here. So on the debit side, we're going to debit cash. For 84,000, and we're going to credit two accounts, deferred revenue for the 7,200, and then sales for the 76,800. So notice I have all my check marks. So I have my debit to 84,000 and my credit to 7,200 and 76,800.